first Friday of the month, and that means, of course, it's non-farm payroll day, the latest US jobs figures, and, some interesting data today. Job growth in the United States has cooled. Unemployment has ticked higher, and perhaps a sign that some of the heat may be coming out of the world's largest economy. And of course, these are important numbers because we've had quite hawkish comments coming out of the Federal Reserve over the last few weeks. We even had some more only a couple of days ago from Jay Powell. Is there a bit of light on the horizon for those that are looking for a rate cut sooner rather than later, rather than higher than longer?
Yeah, Johnny, I think you nailed the nail on the head there, because when we look at the data that came out today, pretty much across the board, this was a lighter print. Now, I do want to go through the numbers really quick, and then I'm going to tell you a little bit of the context here in the full picture. So as you mentioned, the employment change came out lower than expected. We added 175,000 jobs. There was a forecast for 238,000. We also slightly revised the previous number higher, which that last number was high, so it wasn't very much, but we went from 303 to 315. So overall, a cool print in terms of employment change. At the same time, as you mentioned, employment rate or unemployment rate ticked higher, which went from 3.8 to 3.9. So at first glance, you could say, well, hey, this is actually some progress. It's pretty obvious that maybe we're starting to see the jobs market calm down a little bit, which has been, of course, one of the Fed's targets to see come down a little bit. They don't want it to crash entirely, but it seems pretty apparent that in order to get the inflation story under control, we've got to see the labor market relax a little bit. At the same time, one more figure to mention is that the average hourly earnings came out just light month over month at 0.2% compared to 0.3%. This is also very important to the inflation story, how much are wages increasing, so on and so forth. But there's more to it, Johnny. I want to talk a little bit about when it comes to the figure here. Before we get overly excited, and I'm not trying to be the doomsday or naysayer here, what you do have to be aware of is that back in November of 2023, we had a similar setup where we saw a cool print, and it ended up being one big fake out to the whole market. If you remember, November until now, the stock markets around the world, not just the US, they just had a very, very strong rally into the new year. The market was very excited that maybe the inflation story was finally done. And then we proceeded to have, I counted it out this morning, 5 back-to-back higher than expected jobs prints. So, this one, yes, is a sigh of relief. We didn't get a 6th one in a row, but this is only the first one. I think before we get too excited, we need to see this data persist for maybe a few more months, maybe 2 months, 3 months. That's where you're starting to see a secular trend form and not just a one-off print like we saw in November, which ended up not lasting very long. So yes, the market is celebrating. In fact, that's pretty obvious if you're looking at the technology sectors. The NASDAQ is up the most here today. Real estate caught a really strong bid today. You saw, one thing that I track and we don't talk very much on the podcast is I watch solar panel companies. Just an area of, renewable energy is a very debt heavy side of the economy, but it's a very fascinating one to me. And I saw that the solar panel companies across the board, the TAN is the ETF I'm referencing, the TAN ETF was up a lot today. These are interest rate sensitive areas. Same thing with XLRE. That is a real estate ETF that tracks many, many different real estate exposed areas. That was up. And then one other, while we're on the subject of data here this morning, Johnny, was we had the PMI data come out for services. So ISM services PMI did come in lighter than expected. Now, what's tricky here for me, Johnny, is this is a lot of rallying on cool data. And I want to make a quick analogy or comparison to this. The market is rallying very strong on what is slightly lower than expected data, which is weird to me because if the stock markets are rallying on this, it's sort of like someone who is sick saying, I want to get more sick so I can have the medicine. It's kind of a weird analogy to think about, but the question is, do we really want to see real slowing economic data? This services PMI print was a pretty big miss. Do we really want to see bad news in order to get a rally. And that's where, again, I compare it to somebody who wants to get more sick in order to get the medicine from the doctor. It's kind of a weird one. You almost question how much this bad data is actually good news, in my opinion, at least. I think that will be interesting to see where we go with that. But of course, the market is celebrating in the short term the idea that, hey, things are maybe chilling out a little bit and maybe rate cuts are still on the table for the end of the year. Johnny, I just checked before we jumped on here the Fed Watch tool to see what it's at. Still, well, now we've actually seen that there's a slight expectation for 2 rate cuts this year. So it's gone from 1 to maybe we're going to get 2. If you enjoyed this video from the Market Insights Market Pulse podcast, you can listen to the full episode by clicking the link down below in the description. You can find us on your favorite podcasting apps, and again, we post several times a week, so if you're looking for market updates throughout the week, this is the place to be. Whether you're in the car on the way to work or something like that, make sure to tune in to get the latest. Thank you very much for watching. We'll see you on the next one.